Well, let's get to that more on the US debt ceiling, its market implications, and, well, more than just that. Paul Ashworth, managing partner at Cameron Harrison, joins me now. Paul, thank you so much for your time. I mean, it seems like the ultimate act of fiscal suicide if the US were to default. I suppose there's the marginal risk that it could happen, though. I mean, how are you seeing the situation at the moment, especially as an asset allocator?
Well, yes, it is a marginal risk. How it acts, given the polarisation between the two extremes, time will play that out. I don't get too bogged down in it. There are other mechanisms, that are capable of being employed. Certainly, the 14th Amendment's now been spoken about in terms of that. So that would certainly, bring matters to a head. So, I think we just have to operate on the basis that, as is a lot of the case with the US, over the last, particularly 20 years. Solutions, if you like. They tend not to be solutions, they tend to be more resolutions, tend to evolve in a very messily manner. They tend not to be solutions because they find their way kicked down the path a bit. I suspect this will get kicked down the path as well. And I suppose really then on that basis, that we start to think, well, what does the market environment look like? More particularly, what does the federal funds monetary policy stance look like? Going forward over the course of the next quarter and the course of the next 6 months.
Bring on the $1 trillion platinum coin, I say. What about, we'll chuck that in perhaps, just to resolve the issue, the concept for another day perhaps. But what about just how we should be, I guess, anticipating the way markets will react, again, assuming that a deal is going to get done here? Do we just go back to 2 or 3 months ago and then we have to sort of focus again on the Fed outlook and the risk that rates could remain higher for longer and investors have to sort of, I guess, position themselves once again for that dynamic?
Well, yeah, good question. I think it's, we're obviously talking about the Fed funds ceiling and that dynamic. And, we're thinking that, we'll get a reasonably rational, if not a satisfactory, maybe short, medium term solution to that. And markets have or want that sense that will be the case. Similarly, in terms of how markets are addressing monetary policy and where they think the Fed is going, I still sense that markets believe that the Fed has largely done enough. That may not necessarily give rise to a reduction in the Fed funds rate, but it will mark a cessation of further increases. And they're starting to see sufficient signs that there will be a sufficient moderation in inflation, and ultimately what's most important is services inflation and wages growth. And I think that is fair. There we can see that. The name of the game here, the bottom dot there, is 6-month goods inflation. So it certainly has been transitory in terms of inflationary impact. And what we're sitting here with is the real problem, which is services inflation, and services inflation is as is overall inflation. 34% of CPI is shelter, and shelter is therefore by far the dominant factor in services inflation. And so you can still see that whilst it's come off, it's still highly elevated, and it's still pushing wages growth which in itself feeds back in or transmits back into further pressure on rents. We can see those rents there in the top green line. You have to really get your magnifying glass to see the worm turning down, but the worm is turning down, and another measure of that is the Xylo new lease index, which has been turning down now for a number of quarters. But I think it misses the point in terms of that's market expectations. We do see the worm turning variously, but the problem is that the Fed got so far behind the curve on this that it has to get in front of the curve. And to be in front of the curve, it has to see the concrete outcomes. And I think that's kind of where we would see a mismatch between where we think the Fed is at and where the market is wanting the Fed to be at and where it's currently pricing. The Fed wants to see those wage outcomes solidly in place, more than just the worm turning and it ultimately getting to where it ought to get to over the course of the next 15 to 18 months. It wants it to get there before, sizable manner before it'll stop raising rates. And I think that's what the market is perhaps not quite concretely realising.
So, if that's the case, what are the investment implications of that? Positioning right now, there's this whole notion that maybe it's time to reallocate oneself to sort of a more 60-40 classical, if I may refer to it, style portfolio. What would you perhaps suggest, or at least the way that you're sort of thinking about this in terms of asset allocation?
Like most things, we've got to think of things in terms of degrees. Some, we think at current levels, even with maybe one or two further rate increases by the Fed. And we should say, we do get a greater sense that the Reserve Bank has gone back into lockstep with the Fed. That at those levels, our base position or our base scenarios, the US goes into recession. Any more than another one or two rate increases, the real risk is that we go into a hard recession. That's deeper, and that causes significant erosion to the labour stock, and creates significant further financial stress in the US financial system. As things currently stand, Kyle, at these settings, even if they are longer or higher for longer, we are not as pessimistic as some in terms of US equities. We think that would give rise to a pretty good first half of next year rebound. We have seen that there's kind of been earnings adjustments occurring through the market. People are fixated with now, but we're seeing post-COVID earnings adjustments that have been occurring over the last 12 to 15 months or so. So on that basis, certainly an allocation to a higher allocation to US equities, we think is credible and valid. More than that, we have to really revisit that. And if we see that the Fed actually does have its teeth into actually delivering the target before it really starts to ease off, then we think that is going to be a negative for equities both in the US and for here.
One
But
final.
that's
Sorry,
not
go on.
necessarily our base position.
Right. Okay. Just an elevated risk, perhaps.
Yep. Yep.
Just one final question, and this is one that seems to have been, I don't know if it's neglected is the right term, but it's been focused on less than previous tightening cycles, as relatively modest as those tightening cycles happen to be. But it's just the role of the Fed's balance sheet and quantitative tightening. I mean, you've sort of mentioned
Sure.
before about the fact that that is going to be a part of the process from here too. But I mean, does that complicate the issue when it comes to asset allocation, because the market might be hit with an extra supply of treasuries, at a time where obviously the markets are already selling a lot of government debt on the basis that inflation is elevated?
Yep. Yes, I think it does. If you're running 95 billion or so a month, obviously they had to increase balance sheet fairly sharply through March, but they've gone back to reducing the size of it. I think that is an important factor. And I think you are right. It's not as commented or spoken about as much, but I think there's a reasonable conviction there. For the Fed, at least, we said pre-COVID that the Fed's balance sheet, at a bit over 4 trillion, was pretty bloated. So at these 8 and a bit trillion levels, there certainly is a conviction there, and it does potentially, create some difficulty there, and so certainly creates some further upward pressure in terms of bond rates.